Well, good afternoon. For those that are joining us, thank you so much. My name is David Auerbach. I'm the Chief Investment Officer of Hoya Capital. I'm really excited to be joining my old friend and colleague, Jay Hatfield, the founder of Infrastructure Capital Management, also known as Infracap. For those that missed it, Jay was interviewed bright and early this morning on Bloomberg Television. A lot of the comments that he shared actually will be kind of revisited here in this conversation today. But check out Jay's appearance this morning at the Open on Bloomberg TV because it was very, very informative. Also, he was with my buddy Matthew Miller, but that's a separate conversation. Jay, let's kick this off. The title of this presentation is Setting Your Income Playbook for 2025. And obviously the key word here is income. So as somebody who manages several income funds, as well as us managing a couple of different income-focused funds, let's go very high level. How should an investor set their income playbook for this coming year?
Well, I think to do that, it's critical to have a macro view. We're pretty highly differentiated, I guess, at this point. Not so much on the equity side. We have a 7,000 target. Most strategists are 65 to 66. We do, though, forecast the future. So we're forecasting an 18% corporate tax rate. That's what drives. Our target is also 6,600 without a corporate tax rate reduction. 7,500, by the way, if we get 15. That's just arithmetic. Higher earnings, higher growth because of reinvested capital equals much higher stock prices. We saw that in 2017. The more controversial element is that we're mildly bullish on rates. So we're roughly 420. We think we're going to end up 450 to 4 most of next year. We've been making that call since rates hit 450. There's a big Trump trade. Everybody's assuming that Trump's policies are inflationary. We have the opposite view. We think they're deflationary. We think Biden's if he'd ever really was able to implement his program, the $6 trillion of spending, that would have been highly, I don't know if it'd be inflationary, but definitely would have hurt growth. So it does matter what happens to interest rates, but we do think that it's best to be up on the risk curve. So in fixed income and preferred stocks, high yield bonds. Since we're constructive on rates, we do think REITs will continue to rally. We'd rather be up the risk curve on REITs as well, and like office and some more controversial areas, retail, although they've had a big run. And so we think that that's better than being in consumer staples or utilities or these defensive sectors that wouldn't do well in a strong bull market.
All right, so let's unpack some of the stuff that you've already thrown out here because your answers lead to more questions. Let's start. First of all, you start throwing S&P 500 price targets around based off corporate tax rate changes. Can you maybe go a little bit more in depth on your reasoning there and why a 1% move equates to potentially like 250 points on the S&P 500, if I'm hearing it correctly? Can you maybe walk us through some of the math there, your logic?
Yeah, so it's very simple. I mean, so just think back to 2017. If you go from a 35% rate to a 21% rate, then earnings go from 65 cents, that's the after-tax earnings, to 79 cents. And so that's 14 cents higher, which is so like kind of 17% higher. So you saw this big run up in prices. That was, of course, the biggest corporate tax reduction in history. This is a little bit more game of inches. And so it's just simply to take 3% down and do that math, you get a bump up in earnings. But what we do and nobody else does is we also say that you get a bump up in the growth rate of earnings. Most people don't seem to appreciate this, but earnings come from reinvesting. Growth in earnings, comes from reinvesting on an after-tax basis, earnings and depreciation. So if you get a higher after-tax return on that, you're going to grow faster and get a higher multiple. Now, we're not assuming a ridiculous increase in multiple. At the 18% level, we're assuming a 22 multiple, and at 15 rather, a 23 multiple. So most of it comes from just the arithmetic of applying a lower effective corporate tax rate. And so it does need to be effective. Like if it's just, it's 15, but here's all these other increases, you can no longer deduct depreciation or whatever other negative things they want to incorporate in the bill, then you would have to adjust for that. But talking about real effective after-tax return on profits goes higher, then earnings growth goes higher, and PE multiples go higher. And like I said, you can go back and study 2017. It did get interrupted by one of many flawed Fed moves to tighten in the face of no inflation, like 2% inflation. So we almost had a recession. But at least the run up during 2017 was roughly like over 20%. So you can see that just has a direct one-for-one impact on stock prices. Whereas all the other policies that I think partly for political reasons people want to focus on, they don't really matter much. So deporting criminals is not going to matter either way. It's not deflationary. Tariffs, not likely to have a big long-term impact. Everybody talks about the price increase. Nobody talks about the proceeds that would go into investment ultimately. So we think this is important to focus on the critical elements, which is the corporate tax decrease and not all the noise around appointments or other policies.
And then you did touch upon interest rates briefly. If I recall, you said you expect rates to be at 4 to 4.5%. I'm guessing by the end of December of next year.
Yeah, it's 3.5 to 4, but
perfect, even better.
Yeah.
All right. So based off of that, the consensus is that the Fed might cut 25 bips here in a couple of weeks at the final meeting this year. We had Chairman Powell speak yesterday at the New York Times Deal Book event that was all over CNBC. And I think that, again, not to read between the lines, but I think he kind of emphasized that they might be in a pause and wait type situation going into 1Q. So I know you kind of think contra to a lot of folks. Walk me through your thoughts on how you see us getting to 3.5% next year at this rate.
Okay, so it's a little bit complicated with the Fed because you're trying to predict what 19 somewhat incompetent bureaucrats are going to do. So it's kind of two elements.
It's going to be Jay. There we go. Okay.
So I said that on Bloomberg TV as well. So let's see how popular I am with the Fed. But I don't think he's an incompetent. I know journalists don't like that word. But so a good example of that is for the July meeting, we said, they definitely could cut. I think at the time PC was like 2.6, rolled down to 2.6. They didn't cut, but then they cut twice the next meeting. So that's the difference. Like they should have cut and then just cut one more, just 25 basis points the next meeting. But their incompetence, because they have it's not just Powell. He has to herd all the cats to do what he wants to do. He's not as powerful as Greenspan and these other chairmen. So what I think that will happen is we'll know more on Friday. I think the employment report will be pretty strong. It'll be a healthy debate, probably still squeak into a cut. It'll be a bearish cut, a hawkish rather cut. You'll see the SEP, so that's a forecast of cuts, drop from 4 next year to either 2 or 3. So it might be negative for the market still. But this is where the distinction comes in. That's what they're likely to say they're going to do. But we believe, first of all, that inflation's already contained. You can check on our website. We're probably still in the process of updating CPI-R, that's real-time inflation. We're now adjusting it using rental data. It's more real-time. It's broader, includes, David, you might want to comment on this, but, apartments, obviously, with that huge additions of apartments, and it comes out more frequently. It's more reliable than Case-Shiller. So if you do that year over year, CPI is at 0.8%, PC core is 0.6%, and even those numbers are distorted by auto services because that's a pandemic hangover. So inflation's running kind of close to zero, likely to continue to decelerate until the Fed lowers rates more and gets the money supply growing. So we have a completely differentiated view on inflation, and that's why we're comfortable, albeit at a higher level than before Trump was nominated because of growth, but not inflation. This 350 to 4. And last point on this, a long conversation, so it didn't really come out on TV, but we have a global capital market. Doesn't matter much for stocks, but matters a lot for bonds. The bonds are fungible. They're like commodities. Our rates are already 110 over Canada. They're about 120 over Greece and Italy. Obviously not as good at credits as US. So our rates are, the bond vigilantes are already out, and that's what has driven our rates so high. The rest of the world is going to continue probably to come down slightly, should keep our rates under control. But having said that, 420 is not that different than middle of the range 375. We made this call at 450, so we've gotten 30 basis points already, which is really before I would have expected. I think it's more likely that we get below 4 in the in the first quarter when that inflation data starts coming out. But, particularly for your core area, David, at least contained rates are important. I don't know if you want to comment on that.
I mean, when you talk about the 10-year, I've always said 4% is the magic number for us. If it's below 4, it's great for REITs. If it's above 4, it's not so great for REITs. And obviously, there's several different layers. There's the economic academic approach that you take, and I kind of look at real yield type situation. I look at it at 10-year versus dividend income yields, and market cap weighted the yields right around 4%. If you just average all the names that's out there, it's closer to 6%. So the wider the gap between REIT dividends and the 10-year treasury makes real estate a more long-term attractive investment. But for our focus, we echo some similar thoughts to you. We see opportunities in some of the unloved sectors and names like office as an example. There's good stories that are out there that don't get picked up on the CNBCs and Bloombergs because, frankly, doom and gloom headlines sell. So that's just kind of where we sit. But, as a REIT person, I wish I could go through the screen and hug you right now because I'd love to see 375. That'd be great for us, hopefully. All right, so let's kind of bring it back now because we've briefly touched upon the incoming Red administration. So how do you think, I know you briefly touched upon it, but maybe we could expand it out because of the fact that you are in a variety of different asset classes, not just REITs, but MLPs, small caps, preferreds. We kind of play a little bit in the same sandbox together, but with you focusing on some other income type of sectors, what do you feel the impact potentially in the new administration could be to some of these income-oriented sectors? Let me give you my 2 cents real quick. Number one, M&A. I think it's great for those in the M&A side of the equation, especially, again, I think we have too many small cap REITs that are out there. I think we have too many apartment REITs or lodging REITs as an example. So I would not be shocked if we see consolidation in the sector if M&A rules get more friendly. I think that's going to be, I don't want to say day one immediate change, but within the first few months, I think that we could see some major headlines coming out of seeing public-to-public mergers happening again.
So we have the same focus, David, in that what we think, generally speaking, is that investors and voters, for that matter, put way too much emphasis on who's president. President really has fairly limited powers in most situations. But we're going to have the biggest change in antitrust enforcement in the history of the United States. We're going to go from basically, for the first time ever, an administration that opposed effectively every merger ever proposed, usually lost in court, but still deterred M&A from occurring, to what's likely to be at least top quartile in terms of flexibility on mergers. So we're going to have a huge explosion in mergers. It will benefit small caps. We have an S cap as our small cap fund. It's going to benefit smaller REITs, but we're also playing it in a large cap sector using Goldman Sachs, Morgan Stanley, and the big investment banks, because not only are they going to benefit from probably exploding M&A, but also tech IPOs are going to accelerate throughout the year. So we believe we're going to get close to peak investment banking revenues. It's going to feel a lot like the late 90s. If any of you are old enough to have enjoyed that time frame, it's pretty profitable, particularly for investment bankers. So if you look at our ICAP fund, we're pretty heavy on the investment banks. They've been working really, really well. We had this call at the beginning of last year or this year rather, end of last year. It's worked really well, but our earnings estimates are 30% above consensus because we do think we're going to be at peak investment banking revenue generation levels.
Jay, let me put you on the spot here for a second. And this is me as an idiot asking this question. PFFA, all preferreds, PFFR, REIT preferreds, AMZA, MLPs. You're welcome for these plugs, by the way. To the average investor, what's the real difference between ICAP and SCAP funds?
Okay. Well, just the simplest fund we run is PFFR, so it's relevant to your sector. It has smart beta in two ways. First of all, in effect, it has smart beta around the credits because REITs are excellent credits. They have much lower leverage than buildings. So they're very strong credits. They're typically investment grade, even if they're not rated by an agency. They're shadow investment grade. So it has REITs. And we also have a 3% minimum yield to call requirement. So it deals with what's called the call risk. No leverage, good steady dividends. PFFA is our active preferred stock fund, higher yielding. It's about 8.5 yield. More opportunity for optimization. So we can use our judgment. We don't have to follow index to sell above par if it's callable, to pick and avoid bad credits, and also to manage interest rate risk, and also play a new issue. So that fund has higher returns than PFFR, has leverage, so a little bit more volatility, but not a lot. AMZA is a pipeline fund, MLPs, 80% MLPs. Usually you get deferred income. It's covered by cash, but you don't have to pay tax on it, so that's what you want. And then ICAP and SCAP, ICAP large cap dividend income. We rate individual covered calls that helps the income and helps alpha and total return. SCAP, we rate index calls because you don't want to cap your upside with small caps because they can get bought out. We do that in a particular way to not cap our returns. And so we think both of those really all of our funds will be good diversification. Not to be necessarily they'll be tech, but on a risk-adjusted basis they would. We don't recommend investors just play tech or Bitcoin because the volatility, particularly if you have to take any cash out of your portfolio, can be pretty crushing.
Okay, so obviously I've known PFFR for many, many years as a REIT guy. Our high dividend yield ETF, we have a sleeve of preferreds. We're currently the only REIT real estate that combines both common and preferreds in one REIT wrapper, so a REIT ETF wrapper. So it's a little bit of a different approach than what you guys are taking. But again, the one thing that keeps resonating that we keep focusing on is the income. That's the word that we keep talking about here. So I'm going to put you on the spot. What's the one sector that investors should be looking at for income in 2025 right now? Of all your different sectors, what sector do you recommend?
Well, we would be an SCAP. We think from a total return perspective, small caps are going to continue to do well post the Trump election. They tend to do well when M&A is picking up. They are not tech concentrated. They tend to do better, although it's disconnected a little bit from this since the Trump victory, or really the Republican sweep. They used to be very closely correlated with interest rates, but they've kind of broken that mold. They are, though, it's important to note, the small cap indices do have a lot of REITs. They have some utilities. They have financials. So they do often act like they're interest rate sensitive. So just like REITs, if we're totally wrong about rates, you may not want to be in small caps, but if they're contained, and you could even say the 4% area, David, to pick up on your 4% point, contained in that 4% area, they should outperform most other asset classes, with the possible exception of tech. It's kind of don't know how much momentum is going to be in the tech market.
I do want to call one. You made a comment, and you and I think alike about this, that not all REITs are interest rate sensitive. Let's just throw that out there. A cell tower is not interest rate sensitive. Me ordering that package on Amazon off of my cell phone, utilizing 3 different REIT sectors, it's not interest rate sensitive. Excuse me. Me going to the Starbucks next door or in your lobby is not interest rate sensitive. We live our lives using these properties, at least on the REIT side, every single day, and don't think about where interest rates are at, right? So I think to the end investor, don't think about, oh my gosh, where's the 10-year treasury? Can I go buy groceries today?
Yeah, I don't think it definitely doesn't make REITs unattractive. In this very short run, it tends to dominate the flows. So somebody says, oh, rates are up, and they short the IYR, some big index fund, and everything goes down. But usually, to your point, if the fundamentals really aren't driven by interest rates, then they kind of bounce back after that.
You got me all worked up over here. Sorry, you got me all worked up. Wow. Okay. So how about, let's go even more narrow. Wow. How about a handful of names? You mentioned Goldman and Morgan, obviously on the large cap side, because of all the stuff that could potentially benefit there. What about some small cap names that are on your watch list? Like, what are some of your favorite small cap names right now?
Well, so not to beat the same drum, but on the small cap, Jeffries and Lazard, we think will benefit from this likely investment banking boom. So I'd look at that. We do believe that small cap REITs are going to be attractive, and it's.
Give me a name.
Entertainment properties, we think will do well.
Ticker EPR. Okay, why?
Yeah. Just because there's been sort of a short thesis that we're never going to watch movies again, and that they have a really good dividend, and has historically been able to grow earnings. So we think that should do really well.
Okay, keep going. Give me some more.
This is controversial and probably not super timely, but Bloomin' Brands, super cheap stock, been pounded down because the consumer's weak. We do think the consumer is going to be better next year. So second half of 2025, we think that stock will perform well after being absolutely smashed this year.
Okay. You got one more?
That's all that comes to mind in terms of top ideas right now.
All right, I'll give you a couple on the REIT side. I'm a fan of Motive Industrial. Are you familiar with Motive Industrial? Ticker is Mary David Victor. They're a net lease industrial REIT, but they're focused on manufacturing properties. So you like the producers of your highway guardrails and barriers, your garage door tracks and springs. Their tenants have been in place for like 50 plus years type of stuff. And you can't move a pool of zinc down the street as an example. And if we're in this big push to bring back manufacturing jobs domestically, hopefully we'll see a boon in manufacturing properties. So again, a REIT like that could be potentially interesting to look at. Another REIT I'm doing a little bit of a consulting gig with, but it's a very interesting story. It's a small cap healthcare REIT. Today is not the day probably mentioning it because they just did a secondary offering, but it's called Strawberry Fields. The ticker is STRW. Stock's down about 20% today because they just did, like I said, the secondary offering. But, massive supply demand imbalance when it comes to the world of senior housing. Healthcare is a sector that touches all of us in some form or fashion, whether it's going to the hospital, assisted living, skilled nursing, et cetera. Healthcare is a very, unique sector that's kind of plays by its own rules. And there's other great stories that are out there. I mean, I have 50 of these, when it comes to this. But I think one thing to look at, and you briefly touched upon it, is the strength and the quality of the management team. You look at the track record of these guys over the course of many years. What did they learn from previous cycles? How do we make sure we don't make the same mistake twice? A lot of these CEOs, they've got the blinders on. My job is to grow revenues, cut expenses, and maximize profit growth so that our investors get higher dividends. That's what we care about, right? Well, can't control interest rates. All we can do is control the story. And I look at like some of the New York guys as a good example. Look at SL Green and what they've accomplished up there over the past several years, in a declining office market as a point of reference. All right. So what?
David, I sort of forgot to mention one of our controversial smaller cap picks that your comments reminded me. Kilroy is an office REIT. Offices have been well hated for at least 2 or 3 years, really since the pandemic. But they're benefiting not just from back to office, but also they're mostly in the West Coast. And this latest election really rejected all of the pro-criminal legislation and movement that's occurred over the last 4 or 5 years. So we think that San Francisco's on the uptick. You're getting demand from AI startups, back to office. And so we think that's all a good backdrop for Kilroy, high quality tech office space.
Yeah, you just raised a great point because I think when we look at AI as a whole, you're absolutely right as far as the startups for the office side of things, the world of data centers, how AI has impacted data centers. I think it's going to be a very, very interesting story to watch over the next year or two as that sector evolves. I don't know if you happened to see Jeff Bezos' comments yesterday at that same Deal Book conference, but he had some really interesting thoughts. And, the big takeaway basically is that a lot of these AI guys ain't going to make it. A lot of these guys are going to fall by the wayside here pretty quickly. We do have a question here, Jay.
Mm-hmm.
Do you foresee potential dividend increases either due to lower borrowing costs and or increased income in the funds? I believe this is asking about your funds.
Mm-hmm. Well, definitely that's a good question because we do run low leverage, like 20 to 25% leverage. And it was a huge headwind over the last 3 years since the Fed started tightening in late 21. So now that's reversing to a tailwind. So I wouldn't be surprised if we got some pretty substantial dividend increases in response to that tailwind.
I would be a happy camper, that's for sure, both in our funds and plus, in your funds too, since I do on your funds as well. So I hope so.
Yeah, so that would be my guess. So it's a good question. That's something that was a big headwind, now is a tailwind.
You have a guess who's going to take over at the FTC?
That I don't, but I was talking to a client today and I said, like, it could be a homeless guy outside my office and they'd be way better than Lena Khan. So,
buddy, I don't feel safe outside your office after, what
exactly,
just happened down the street yesterday.
Exactly. But obviously that's a massive exaggeration. But after the new SEC chairman was nominated, it's clear that President Trump is looking for deregulation. So, whether it's the most aggressive deregulator or a little bit more conservative, it kind of doesn't matter. It's going to be just so much better than having the FTC approve essentially everything every merger ever created, that it's going to be a big positive.
What's your thoughts about Bitcoin in general? It's not an income generator. It doesn't pay dividends or anything like that. Do you see, is there any world where Bitcoins and REITs could intersect? You know, if we hit this $100,000 number, next stop, what, 1 million? I guess that's where the chat, I mean, again, I know we're way out there, but, Bitcoin ain't going away anytime soon. What's your thoughts when it comes to that? I mean, is Infracap about to start launching a Bitcoin ETF anytime soon?
No, I mean, we do think, the way we think about it is, if you buy profitable companies like REITs, like in your funds or in our funds too, because we only screen for profitable. There aren't any unprofitable REITs as far as I know, at least on a FFO basis. So good companies that are reinvesting, growing earnings by reinvesting, you're going to win in the long run. So it's like you're going to the casino. Well, it's like you are the casino and you're taking 5 or 10 or 15% off the top of all money gambled. So that's our primary investment strategy. Really, in our ETFs, that's all we do, is these profitable companies. Some are preferreds and paying dividends. But some people, which I don't necessarily recommend, but some people like to have a portion of their investment in what I would call gambling securities. So they're probably in the long run inferior to your profitable companies. They may feel better when there's a run up to 100,000 when Trump gets elected, but there's going to be a crash that could be twice as bad as that at some point. It could be 300,000 to 50. I don't know exactly what the numbers are, but just to be fair to the asset class, it's way better than going to Vegas. So if you like to gamble a certain amount at Vegas, you could stop doing that. Have 5-10% of your quote investment portfolio, your liquid assets at least, and speculate on Bitcoin. In our hedge fund, we will trade the volatility around Bitcoin, so options. This is very volatile, so it's good for that type of gambling activity, higher risk activity. But we don't subscribe to, it should be 5% of everybody's investment portfolio.
Last macro topic is housing. Probably our number one thesis that we focus on: lack of home affordability, supply-demand imbalance, elevated mortgage rates. I mean, there's enough press that's out there that we know about the why of housing and why I think resi REITs and single-family rentals are a good sector to be in. What's your take on the world of housing?
Well, we became a little bit concerned when the 10-year went to 450 and the 30-year mortgage went above 7. And we thought that we might have a pretty significant slowdown in housing, notwithstanding the shortage and everything you mentioned. But, the best cure for higher rates is higher rates. So we did get up to that level. And, I think there was some pension fund rebalancing. Some other people may feel the same way we do, that it's not sustainable up there. So we do think that the housing market will recover, that we'll get below 4% on the 10-year. The 30-year mortgage will get more into the 6.5%, and you'll see more housing starts, more of secondary sales, because you'll have fewer people locked up. So we're bullish on it, but it is one of the more interest rate sensitive portions of REITs. So your comments about a lot of REITs at least not really being that interest rate sensitive. So it's not just from a trading perspective, but the actual business of housing does get impacted by the level of rates.
Do you think we'll ever see a 3 handle on mortgage rates again, or a 2 handle?
I hope not, because that means we had something like the pandemic. I think that given this 56 trillion in global pension assets, probably quite high growth in the US for the foreseeable future, I guess 4 years specifically, until we get maybe a gigantic corporate tax increase if we had a Democratic sweep, that you're going to be sort of in the range we already said. I mean, we were saying 3 to 4 on the 10-year. And then in terms of mortgage rates, then you would, add, I think the spread might come in there's a big spread. When rates are really high, there's a big spread because there's a refinancing risk. So you could end up with sub 6% mortgages, which would be fantastic for the housing sector.
That new normal. Get to use that new expression all over again. New normal. Well, Jay, we're hit the end here. So what last parting thoughts would you like to leave with the audience today?
Well, would reemphasize something I said on television, which is this Fed is very flawed. One of the reasons we got used to low rates is they created the great financial crisis. They raised rates 17 meetings in a row when inflation was never above 2. So they used to treat 2% as a target. I'm sorry, as a ceiling, not a target. And that really destroyed the housing market for 5 or 6 years and kept rates probably at unsustainably low levels. So I would continue to focus on that and watch the Fed to see. I mean, they've already gone to an average of 2, but hopefully they reform themselves and start to allow 2 to 3% inflation, which is healthy for investment, healthy for real estate, doesn't hurt consumers, and creates less radical cycles that can cause rates to really drop to 0.
Well, I thank you for the time. This has been great. Obviously, if people want to learn about Hoya's ETFs, they can reach out to me. They can get my contact info from Craig or from you. And, I love getting together with you, talking about REITs and income products. And I look forward to seeing you again in person here very soon.
Thanks, David. It was a great conversation. Appreciate it.
Thank you, Jay. I appreciate this. This is a good time today.